Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. 14 weeks ago here, and at every opportunity since, I have said, and I quote, "The only other thing to bear in mind is not here on this daily chart, but in Chicago soybean meal." And that is the well-highlighted annual key reversal down we saw there for 2023. Not directly related here, but not worth ignoring either. End of quote. Now, I know I sound utterly boring, but this point is important, and I feel I must keep repeating it, such that in all things this year and going forward, all things should be seen in the shadow of this pattern. Okay, so since the low in mid-August, we have seen the creation of three patterns. Firstly, a mid-August to mid-October bull channel. Secondly, a late July to late September reverse head and shoulder pattern with a bright red neckline, currently at 1026. I'd previously set out potentials for this pattern of a primary target X overhead in the 1096 area and a secondary hard to reach target X1 up in the 1123 area. And the market tried up towards the primary target X during late September within the bull channel, but just missed reaching the primary target X, mainly due to the bearish pressure of the declining mauve medium moving average, currently at 1022. Remember, that's going to come up. And it was capping and slapping the market lower. I am still considering retiring these two targets now, but I'll leave them on for yet another week. Then there is the third pattern, the early July to early October bearish shift pitch, highlighted in dark blue on my daily chart. This pattern is still operational. It looks quite good for now, with the market in between the overhead upper time currently at 1035 and the middle time below currently at 940. There is another pattern I'd like you to consider, one I spoke about 7 weeks ago when I said, as a big picture item idea, to look at the action since the double top in May as a possible descending scallop pattern. For this pattern to realistically work, prices, and I quote from 7 weeks ago, will have to soon hold and then decide whether they wish to remain bullish or bearish before making their move. It's a bit early to say if this pattern will fully deploy right now. End of quote. Now, I have been waiting for this pattern to deploy ever since, and it has not. Now, my patience for this potential pattern is wearing thin, and I am considering removing this completely. I would rather still follow what I said 2 weeks ago, and I quote, "Just watch the dark blue bearish shift pitch for the immediate bearish angle of attack, with some diminishing potential targets below for what may turn out to be a failed targets for a reverse head and shoulders bottom." End of quote. One further item I'd like you to consider, and that was what I saw last week as a small October-based double bottom, which has since developed into an October and early November-based triple bottom that has reached both its primary and secondary targets topside, with the pipe top formed 2 weekends ago. I also note how the green short medium moving average, currently 1020, the bright red neckline, the mauve medium moving average, and the dark blue upper time are all quite congested as a resistance area between 1020 and 1035, squashing down quite a bit. Chicago soybean meal. The main pattern driver in this market had been, and I suppose still is, the dark blue November 23 to early May 24 bearish shift pitch that you can clearly see on my daily chart. The market is currently in between the overhead upper time, currently at 306.80, and the middle time below, currently at 259.20. This pattern had been previously breached and arguably broken, with prices having consecutive closes over the dark blue upper time. However, please note, this break higher was not a spontaneous move, but rather the result of construction of bullish incentives, notably the mid-August to early October bull channel that petered out. and we saw a subsequent break lower at the start of October. The cap on the market was a combination of the upper bull channel line and a declining long moving average, currently at 332.60, that saw just a single close over before swiftly turning lower, all at the start of October. The break below the bull channel saw both the primary and secondary targets below achieved. Now, I raised the point 5 weeks ago about both primary and secondary targets and more. That, and I quote, if this should come about, then it raises the point that the dark blue bearish shift pitchfork could have repaired the break higher. I now only need to remind you once again of my words of 67 weeks ago, so that's now 73 weeks ago, so 67, but it's actually 73 weeks ago. And ever since, when I pointed out that the Chicago soybean meal was about to have that rarest of patterns, an annual key reversal down. This duly came about at the end of 2023, and we've been living in the shadow of this pattern ever since. End of quote. If there's only one thing you take away from my musings, let it have been those words. Now, 2 weeks ago I highlighted a new pattern, one that's developed since that high seen in early October, and is the bright red mid-May to early October bearish Andrews pitchfork. The market has been running along the top of the middle time, currently at 288.5, for quite a few weeks now. So you can see this tine is providing a pretty good snapshot of the bearish angle of attack of this market. I do not think this new bright red pitchfork will yet replace the dark blue pitchfork. Rather, I suspect they will be working together, with the bright red one having a slightly more acute bearish angle. Chicago soybean oil. The main recent actions over the summer here had been the construction of an early July to late August bear channel that almost from the start broke down through a key support that became a resistance, then a support, if only just, and is now once more a resistance. And that is the bright red highlighted neckline extension, currently 45.57 of the October 2019 to February 2020 head and shoulders top. The end of the move down of the bear channel finished in mid-August really, in the middle of nowhere. However, it was not a simple end, as the price over August to September took a second crack at heading lower, which failed in mid-September, and we ended up with an August to September double bottom. Both the primary and secondary targets for this pattern were reached on the upside. Additionally, going back to the earlier old bear channel pattern, we had topside potentials for a break up and out of this pattern. The primary target was reached, but the secondary hard to reach target X3 up in the 49.50 to 49.60 area is still outstanding, though I am now considering retiring it as the market has developed other opportunities and patterns since then. So what has developed over the last few weeks that stimulated such a rise? Now, I suggested 2 weeks ago the construction of a new mid-September to mid-October bullish shift pitchfork, which is highlighted in purple on my daily chart. This purple bullish shift pitchfork is at a slightly less acute angle than the bullish Andrews pitchfork for the same move. It looked like this purple bullish shift pitchfork might show the bullish angle of attack, especially when the top side was breached 2 weeks ago, but then rejected by the combination of the erosion of the purple upper tine and the interesting erosion by the upper tine, I showed, not of the upper tine, so the purple upper tine was eroding the market. And the interesting 38.2% Fibonacci line for March 2020 to April 22 move at 48.95, which I pointed out last week, has, and I quote, capped prices in July, start of April, the end of March, mid-February, and throughout January, as well as this past week, end of quote. This saw a market drop and then a hesitation, a possible halfway hesitation around either side of this past weekend, and a drop down this week through some notable support such as the 2014 high at 45.04, the May 23 low at 44.68, the slowly declining long moving average currently 44.52, and importantly the purple lower tine, the April 2014 high at 43.94, the important 50% absolute Fibonacci line at 43.80, and yesterday and today testing the short medium moving average and pushing down through it today, currently at 43.38, and the medium moving average also, which is currently at 43.20. Below we now have the April and May lows at 42.67, and we're testing the April one at the moment. And I'm considering, despite the erosion that has surely happened to the bearish incentive by these supports, I'm considering either downgrading or even retiring this purple bullish shift pitchfork completely. Now, there are 2 points to consider going forward. The move lower has brought us within a congestion zone formed between mid-September to late October and between approximately 41.5 up to about the 2014 high at 45.04. If this congestion further erodes, which is seemingly happening at the moment, the bearish incentive, if it erodes that bearish incentive, all well and good. However, if we look back at the bearish halfway hesitation pattern formed since the beginning of last week, we can see a potential target for this move below in the 42 even zone, a significant way towards the bottom of the congestion. It all very much depends on whether the market has been sufficiently eroded by its fall down through so many previously highlighted levels so as not to have any further use for the bearish incentive, or it has not, and we are actually looking at the moment as if we still have some. But it will very much depend if we can get down to 42 even.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.